The Federal Reserve just revealed something that most people will not understand until it starts showing up in their mortgage rate, their savings account, their taxes, their paycheck, and the purchasing power of their money. The important part is not simply that interest rates stayed the same. That is the headline. The real story is that the institution at the center of the entire dollar system is becoming divided at exactly the moment when the debt math is becoming harder to ignore. That is what matters. When a central bank knows exactly what it wants to do, markets can price the path, investors can adjust, businesses can borrow or wait, households can make decisions with some sense of the cost of money. But when the central bank is divided between saving the currency and saving the economy, the situation changes. One group wants to raise rates to defend the dollar and fight inflation. Another group wants to cut rates to support growth, jobs, housing, businesses, and borrowers. And between those two positions sits the largest debt burden the United States has ever carried. That is the machine. The first announcement was that the Federal Reserve is not cutting interest rates. It is also not raising them. It is holding them where they are because it does not know with enough confidence which risk is greater right now. That is important. The Fed is not saying the economy is clearly strong. It is not saying inflation is solved. It is not saying jobs are safe. It is not saying the dollar is under perfect control. It is saying the risks are balanced badly enough that moving too quickly in either direction could create a different kind of problem. If the Fed cuts, it may stimulate borrowing, spending, housing demand, stock speculation, and business investment. That can help an economy that is weakening, but it can also reignite inflation, especially when energy prices are already putting pressure on the system. If the Fed raises, it may defend the dollar and slow inflation, but it can also crush borrowers, weaken housing, slow business hiring, pressure the stock market, and make the government's interest burden heavier. So the Fed pauses. A pause can look like stability, but sometimes a pause is not confidence. Sometimes a pause is uncertainty. That is the first signal. The second announcement was more revealing. The vote was deeply divided. That matters because central banks depend on credibility. Credibility is not only about policy, it is about the appearance of a coherent reaction function. If the public believes the Fed will act consistently to control inflation, inflation expectations may remain anchored. If markets believe the Fed will support the economy during downturns, risk assets may behave differently. But when policymakers inside the Fed begin pulling in opposite directions, the market has to ask a harder question. What is the Fed actually trying to protect? Is it trying to protect the dollar? Is it trying to protect jobs? Is it trying to protect the Treasury market? Is it trying to protect asset prices? Is it trying to protect its own independence in a normal cycle? The answer might be clearer. In a late-stage debt cycle, the objectives begin to conflict. That is the deeper issue. A central bank cannot always protect everything at the same time. If inflation is too high, cutting rates may protect jobs but weaken the dollar. If the economy is slowing, raising rates may protect the dollar but weaken employment. If the government's interest burden is already enormous, keeping rates high may improve inflation credibility but worsen the fiscal problem. If the Fed prints to help the Treasury market, it may stabilize debt but weaken purchasing power. This is why the vote matters. Division inside the Fed is not just institutional drama. It is a symptom of a system with no painless choices. The third announcement was about leadership. The current chair is stepping down from the chair role but not leaving the Federal Reserve Board. In the source story, Jerome Powell says he will remain on the board until an investigation by the Department of Justice is finished with transparency and finality. That may sound like a procedural detail. It is not. Fed decisions are made by vote. If Powell leaves the chair position but remains a voting or influential member of the board, his presence may continue to shape policy. That means a new chair may not immediately have the clear majority that some political actors expected. This is important because President Trump has been demanding lower interest rates. The expectation was that a new chair, Kevin Warsh, would make it easier to move the Fed toward cuts. But if Powell remains inside the institution, the policy balance may be more complicated. This is how institutions work. Power is not only the title, power is the vote. The relationships, the credibility, the internal influence, and the ability to shape the policy discussion. A new chair can change tone, but a chair does not control the Fed like a private company. The Fed is a committee system. That means the future path of interest rates may not be as simple as political pressure plus a new appointment. Markets like simple stories. The Fed is now giving them a more complicated one. And behind that complication sits the net interest trigger. This is the part that ordinary people rarely understand. The United States government owes more than $39 trillion. That number is almost too large for the mind to process. When numbers become that big, people stop reacting to them. They become background noise. But the interest on the number is not background noise. The interest is cash flow. The United States government now pays more than $1 trillion a year in interest on its debt. That is not money being spent on roads, bridges, defense, education, healthcare, research, or productive investment. It is money paid because of borrowing that already happened. And the government has one main source of revenue: taxes. That means a growing share of tax dollars is not funding current services. It is paying interest on past deficits in the source. The estimate is that roughly 20 cents of every dollar paid in taxes goes toward interest on the debt. That is a remarkable fact. It means the taxpayer is no longer only funding government. The taxpayer is funding the carrying cost of the government's past choices. That changes the political economy. When interest costs are small, they can be ignored. When interest costs become one of the largest budget items, they begin to shape policy. This is why some people believe the Fed's mission may change in practice, even if the formal mandate remains the same. The Fed traditionally talks about inflation and employment, price stability and maximum employment. But in a high debt world, there is a third force that becomes impossible to ignore: debt service. If interest rates are too high for too long, the government's own financing cost becomes a problem. If the government's financing cost becomes a problem, the bond market becomes a problem. If the bond market becomes a problem, every interest rate in the economy becomes a problem. That is the net interest trigger. The debt becomes so large and the interest expense becomes so heavy that the central bank can no longer think only about inflation and employment in isolation. It must think about the stability of the funding system. This is the trap. If inflation is high, the Fed should keep rates high or raise them, but if debt service is too expensive, the system wants lower rates. If the economy is weak, the Fed should cut rates, but if inflation is still sticky, cutting rates may weaken the dollar. Every choice solves one problem and worsens another. That is what late-stage debt cycles look like. Now, Kevin Warsh's proposed approach, as described in the source, is to cut interest rates while shrinking the Fed's balance sheet. At first, that sounds like a clever compromise. Cutting interest rates stimulates the economy. Shrinking the balance sheet removes money from the economy. So in theory, the Fed can lower borrowing costs while offsetting the inflationary effect by reducing liquidity. That is the idea. But ideas are easy. The question is whether the system can absorb it. Let us break down the two parts. First, rate cuts. If interest rates fall, borrowing becomes cheaper. Mortgage rates may decline. Car loans may become less expensive. Businesses may find it easier to borrow for expansion. Consumers may spend more. Asset prices may rise because lower discount rates increase the present value of future cash flows that can support the economy. But it can also increase inflation. If mortgage rates fell sharply tomorrow, many buyers who were priced out could re-enter the housing market. More buyers chasing limited housing supply can push prices higher. That is inflationary in a real-world sense, even if the official calculation handles housing in a complicated way. The same applies to cars, credit, business, investment, and speculation. Lower rates increase demand. If supply does not rise enough, prices rise. That is the problem with cutting when inflation is not fully controlled. Now add oil. Higher oil prices make the inflation problem more dangerous. Oil affects more than gasoline. It affects diesel, shipping, fertilizer, plastics, packaging, aviation, agriculture, and the transportation of goods. If oil rises because of conflict in the Middle East or supply disruption, inflation can re-accelerate from the cost side. That creates a difficult situation. If the economy is slowing and oil is rising, the Fed faces stagflation pressure, weak growth plus high inflation. That is one of the hardest environments for a central bank. Cutting rates helps growth but can worsen inflation. Raising rates helps inflation but can worsen growth. Holding steady may be the least bad choice, but it does not solve either problem quickly. This is why the pause matters. The Fed is not simply waiting because everything is fine. It is waiting because the risks conflict. Now, the second part of the Warsh plan is balance sheet reduction. The Federal Reserve's balance sheet grew because the Fed created money and used it to buy assets, especially Treasury securities and mortgage-backed securities in ordinary language. When the government needed funding and the market needed liquidity, the Fed created money and bought debt. That added liquidity to the system. If the Fed shrinks its balance sheet, it does the opposite. It sells assets or lets them mature without reinvesting, reducing its support for the bond market and withdrawing liquidity. In theory, this can fight inflation. If the Fed removes money from the system, it can reduce some inflationary pressure. But there is a major consequence. If the Fed stops buying treasuries or sells treasuries, someone else must buy them. The United States government continues running deficits. It still needs to borrow. If the Fed steps back, private investors, banks, pension funds, foreign governments, households, and institutions must absorb more of the supply. If demand is strong, yields may remain contained. If demand is weak, yields must rise to attract buyers. This is basic supply and demand. When the government issues more debt and one of the largest buyers reduces participation, the market may demand a higher interest rate. That is where the danger appears. Treasury rates are the foundation of the financial system. In textbooks, treasuries are treated as the risk-free rate because the United States government can tax, borrow, and in cooperation with the Fed, create dollars. Every other interest rate is priced relative to this foundation. Mortgages, corporate bonds, car loans, credit cards, bank loans, business loans, investment valuations, all of these are influenced by Treasury yields. If Treasury yields rise, borrowing costs rise throughout the economy. A bank deciding what mortgage rate to charge compares your risk to the risk of lending to the government. If the government pays a higher rate, the bank must charge you more. You are not safer than the government. You are a household. You can lose your job. You can miss payments. Your income can fall. So your rate must be higher than the Treasury rate. That is why rising Treasury yields push up mortgage rates. And when mortgage rates rise, housing affordability weakens, buyers pull back, sellers sit longer, prices may soften, construction may slow, home-related spending may decline. This is how Treasury market pressure moves into the real economy. Now, Kevin Warsh reportedly argues that shrinking the balance sheet will not necessarily raise interest rates because private demand will be sufficient to absorb the debt. That would be the best case outcome, but it is not guaranteed. If private investors willingly buy enough Treasury debt at current yields, the plan may work. The Fed can reduce its balance sheet, inflation pressure may ease, and rates can be cut on the short end without destabilizing long-term rates. But if private demand is not strong enough, yields rise. And if yields rise, the plan becomes self-defeating. The Fed might cut short-term rates, but long-term rates could rise. Mortgage rates could rise. The government's interest burden could rise. Financial conditions could tighten anyway. This is the risk. A central bank can influence short-term rates directly. It does not fully control long-term market rates if bond investors lose confidence or demand more compensation. That is why the Treasury market is so important. It is the market that tests policy credibility. If the Fed says, we can cut rates and shrink the balance sheet without causing inflation or higher yields, the bond market may agree, or it may not. The bond market will demand evidence. This brings us to an important possibility. If the Fed shrinks its balance sheet and the government still needs to sell enormous amounts of debt, there may need to be some form of private demand support that could come naturally from investors seeking safe yield. It could come from banks. It could come from pensions. It could come from foreign buyers. It could come from regulatory incentives. It could come from forms of financial repression that encourage or pressure institutions to hold government debt. We do not know. But the question must be asked, who will buy the debt? That is one of the most important questions in the world right now. A government with small deficits does not need to ask that question as urgently. A government with large deficits and a central bank trying to shrink its balance sheet does. If the answer is not clear, volatility follows. Now, another major change discussed in the source is redefining inflation. That may sound technical, but it is deeply important. Inflation is not only a measure, it is a political and financial instrument. How inflation is measured affects cost of living adjustments, public perception, social security calculations, wage negotiations, interest rate policy, bond markets, and the credibility of the central bank. The way inflation is measured today is not identical to how it was measured decades ago. Housing is treated differently. Product substitutions matter, quality adjustments matter, weightings matter. Many people feel that official inflation does not match their lived experience. That gap between official inflation and felt inflation is dangerous. If the official number says inflation is 3%, but households feel that their actual cost of living has risen much more because rent, insurance, groceries, property taxes, housing, and cars have surged, then trust erodes. People do not live inside official formulas. They live inside their own monthly expenses. If inflation gets redefined again, investors must pay attention. A change in definition can change the appearance of the problem without changing the lived reality. It can make policy look more successful. It can influence expectations. It can affect how people interpret real returns. This is why you must measure your own inflation. Not only the government number, your housing costs, your food costs, your insurance costs, your transportation costs, your medical costs, your taxes, your energy costs, your education costs. That is your personal inflation rate. If your personal inflation rate is 8%, and your savings account pays 4%, you are losing purchasing power, even if official inflation says something lower. This is how ordinary people fall behind. They look at nominal dollars instead of real purchasing power. They think their paycheck went up because the number is higher, but if the cost of life rose faster, they are poorer. This is one of the most important principles in money. Your paycheck is not measured in dollars. Your paycheck is measured in what it can buy. The source makes the point that the average person feels poorer than before the pandemic because inflation reduced the value of wages and savings. Even if the official cumulative inflation number is around 22% over several years, many households feel a much larger increase in their real cost of living. Housing is more expensive, insurance is more expensive, food is more expensive, travel is more expensive, property taxes may be higher, repairs are more expensive. That is lived inflation. If wages and savings did not rise enough to match that, real wealth fell. This is why central bank policy matters to ordinary people. It is not abstract. When the Fed cuts rates too much and money expands too quickly, inflation can reduce the value of your paycheck. When the Fed raises rates too much, borrowing costs can hurt housing, jobs, and businesses. When the Fed shrinks the balance sheet, bond markets can move. When the Fed changes inflation definitions, perceptions, and policy can change. These decisions appear distant, but they reach into the household. Now, the source also mentions that Warsh may reduce regular press conferences and abandon forward guidance. Forward guidance is the Fed's way of signaling what it may do in the future. It shapes market expectations. If the Fed says rates may stay high for longer, markets price that. If it suggests cuts are coming, markets respond. Forward guidance became a major tool because expectations can move financial conditions before actual policy changes. Abandoning or reducing forward guidance would change the game. Markets would receive fewer hints. Uncertainty could rise. Traders would have to rely more on incoming data and less on Fed signaling. Volatility could increase because every inflation print, jobs report, oil move, or speech could carry more weight. This may be intentional. A central bank may want to avoid being trapped by its own guidance. If it promises too much, markets may overreact. If conditions change, the Fed may lose credibility by reversing course. Reducing guidance can preserve flexibility, but flexibility for the Fed can mean uncertainty for markets. That is the trade-off. If press conferences are reduced, the communication channel changes. Investors lose some of the interpretive signals they are used to that may make markets more data sensitive and more volatile. Again, no free lunch. Every policy tool solves one problem and creates another. Now let us step back and see the full system. The Fed holds rates steady because it is caught between inflation and growth risk. The internal vote is divided because the policy trade-offs are becoming harder. Powell may step down as chair but remain on the board, complicating the expected shift toward cuts. Warsh wants lower rates to stimulate the economy but also wants to shrink the balance sheet to limit inflation. Shrinking the balance sheet could reduce liquidity but also reduce demand for treasuries. If Treasury demand weakens, yields may rise. If yields rise, mortgage rates and other borrowing costs rise. If borrowing costs rise, the economy slows. If the economy slows, pressure to cut rates increases. If the Fed cuts too aggressively, inflation may rise. If inflation rises, the dollar weakens and real wages suffer. This is a loop. The system is not simple. That is why you cannot rely on slogans. Cut rates sounds good if you have a mortgage, a business, or a stock portfolio. Raise rates sounds good if you worry about inflation and the dollar. Shrink the balance sheet sounds good if you fear money printing, but each action has consequences. The mature investor studies the consequences, not the slogans. What does this mean for asset prices? If rates are cut successfully without inflation accelerating and without long-term yields rising, risk assets may benefit. Stocks, real estate, and speculative assets could rise because money becomes cheaper. If the balance sheet shrinks and Treasury yields rise, that could pressure stocks, housing, and credit markets. If inflation remains high, real wages suffer. Gold and real assets may gain support, and bond investors may demand higher compensation. If the economy weakens, companies may reduce hiring and earnings may decline. If the Fed is divided and communication changes, volatility may rise. So the range of outcomes is wide. That means risk management matters. Do not build a portfolio that only works if rates fall. Do not build a portfolio that only works if inflation collapses. Do not build a portfolio that only works if the dollar stays strong forever. Do not build a portfolio that only works if the Fed rescues every market decline. A resilient portfolio must survive several policy paths. This is how I would think about it. First, protect liquidity. You need cash or cash, like instruments for emergencies and opportunities. Liquidity is what prevents forced selling when volatility rises. Second, avoid high interest consumer debt. Credit cards and expensive loans are dangerous in uncertain rate environments. If the economy weakens, debt becomes heavier. If rates rise, variable debt becomes more costly. Third, own productive assets over time. Stocks of strong businesses, broad index funds, and companies with pricing power can help protect purchasing power over long periods, though they will be volatile. Fourth, consider assets that hedge debasement risk. Gold, certain real assets, and inflation-sensitive exposures may have a role if monetary credibility weakens or inflation persists. Fifth, be careful with long-duration bonds if long-term yields rise because Treasury demand weakens or inflation expectations rise. Long-duration bonds can fall. Bonds may still have a role, but understand duration risk. Sixth, watch the Treasury market. Treasury yields are the pressure gauge of the whole system. If yields rise while the Fed is trying to cut or shrink the balance sheet, that tells you the market is challenging the policy path. Seventh, measure real returns. Do not ask only whether your account balance is rising. Ask whether your purchasing power is rising. Eighth, do not overreact to one announcement. The Fed is a slow-moving institution, and markets often move before policy changes are fully implemented. One meeting matters, but the path matters more. Now, for households, the most important lesson is that the value of money is not stable just because the number is stable. If your savings account shows $50,000, the number may not change. But if the cost of life rises 20, 30, or 40% over a period of years, that $50,000 buys much less. That is a loss. It is just not shown as a red number on a brokerage statement. Inflation is a drawdown in purchasing power. People understand market drawdowns because they are visible. They misunderstand inflation drawdowns because they are hidden inside prices. That is why inflation can be more politically dangerous than a stock market decline. It affects everyone every day in ways that feel unfair and hard to escape. The paycheck loses value, savings lose value, debt behaves differently. Assets reprice, people begin to question the system, and when people lose faith in the currency, central banks face a credibility problem. That is why some Fed members may want to raise rates to save the dollar. A currency depends on trust. If people believe the central bank will allow inflation to run, they demand compensation, bond yields rise, wages adjust, prices adjust. People look for alternatives. The currency weakens. Defending the dollar can require tighter policy, but tighter policy can hurt the economy. That is the contradiction. The dollar and the economy can demand different medicines. In a low-debt world, this would be easier. In a $39 trillion debt world, it is much harder. Higher rates defend the currency but raise the government's interest cost. Lower rates support debt service and the economy but risk inflation. Shrinking the balance sheet reduces money supply but may raise Treasury yields. Printing supports the bond market but risks debasement. There is no painless exit. This is why the leadership transition matters. A new chair does not inherit a clean machine. He inherits a debt machine, an inflation problem, a divided committee, a political environment demanding lower rates, a bond market watching supply and demand, and a population whose purchasing power has already been damaged. That is the reality. The best investors will not focus only on personalities. They will focus on constraints. What can the Fed actually do? What will the bond market tolerate? What will inflation allow? What will the economy absorb? What will the Treasury market require? What will political pressure demand? The person in the chair matters, but the system matters more. Now, suppose Warsh tries to cut rates while shrinking the balance sheet. There are several possible outcomes. Best case, short-term rates fall, private demand absorbs treasuries, inflation does not accelerate, the economy stabilizes, and markets rally. That would be the clean outcome. Another case, short-term rates fall but long-term yields rise because investors demand higher compensation for holding treasuries. Mortgage rates may not fall, housing may not improve. The government's interest burden may stay high, markets may become confused. Another case, shrinking the balance sheet tightens liquidity too much. Risk assets fall and the economy weakens. Another case, cuts stimulate demand while oil keeps inflation elevated, forcing the Fed into another credibility fight. Another case, policy communication changes increase volatility because markets no longer know how to interpret the Fed's future path. A good investor does not pretend to know which case will happen. A good investor prepares for the range. That is the difference between prediction and principles. I prefer principles. The principles are simple. Do not rely on one institution to preserve your purchasing power. Do not hold all wealth in cash if money is being debased. Do not ignore liquidity because assets can fall. Do not use high-interest debt because uncertain policy can make cash flow fragile. Do not chase yield without understanding duration and credit risk. Do not assume official inflation equals your inflation. Do not assume lower rates are automatically good if they come with higher inflation. Do not assume shrinking the balance sheet is automatically good if it destabilizes Treasury demand. Do not assume political pressure and central bank independence can coexist smoothly without conflict. This is a time for clear thinking. The Fed's decision to hold rates is not boring. It is a signal that the system is at a decision point. The divisive vote is not trivia. It is evidence that the trade-offs have become severe. Powell staying on the board is not a footnote. It may influence the balance of power inside the institution. The net interest problem is not an accounting detail. It is a structural constraint on policy. Balance sheet reduction is not technical plumbing. It affects liquidity, treasury demand, and interest rates across the economy. Inflation definition changes are not semantic. They affect perception, policy, and purchasing power. Forward guidance changes are not communication preferences. They can alter volatility and market expectations. All of this matters because the dollar is not just America's currency. It is the reserve currency of the world. If the Fed changes how it operates, the effects move globally. Currencies, commodities, bonds, stocks, real estate, crypto, trade, and foreign central banks all respond to the dollar system. That is why you must pay attention, not with panic. With understanding, now let us bring this down to the personal level. If your paycheck has not kept up with the real cost of living, you have already experienced monetary policy through purchasing power. If your rent or mortgage payment has risen, you have experienced it. If your grocery bill feels much higher, you have experienced it. If your savings account earns less than your personal inflation rate, you have experienced it. If your dream of buying a house moved further away because mortgage rates rose, you have experienced it. You do not need to work at the Fed to be affected by the Fed. You are inside the system, whether you understand it or not. Understanding gives you choices, not perfect choices, but better choices. You can choose to build emergency reserves. You can choose to reduce bad debt. You can choose to invest consistently in productive assets. You can choose to hold some assets that protect against debasement. You can choose to negotiate income. You can choose to avoid lifestyle inflation. You can choose to understand real returns. You can choose to watch the Treasury market. You can choose not to be fooled by nominal numbers. This is the real point. The average person reacts after the policy shows up in their wallet. The informed person studies the mechanism before the pressure becomes obvious. That is how you stay ahead of the curve. If the Fed cuts, understand why. If the Fed holds, understand why. If the Fed raises, understand why. If the balance sheet shrinks, ask who buys the treasuries. If inflation gets redefined, measure your own cost of living. If forward guidance disappears, prepare for more volatility. If the dollar weakens, ask what you own that protects purchasing power. If rates stay high, ask whether your debts and investments can survive. This is not about predicting tomorrow. It is about understanding how the machine works. The machine is becoming more complicated because the easy choices are gone. The debt is too large. Inflation is too politically damaging. Interest costs are too high. The economy is too sensitive to rates. The bond market is too important. The dollar is too central, and the Fed is too divided. That is the environment. A person who wants a simple answer will struggle in that environment. A person who thinks in systems will do better. So do not obsess over one Fed announcement. Study the forces behind it, the force of debt, the force of inflation, the force of political pressure, the force of interest expense, the force of Treasury supply, the force of private demand, the force of purchasing power erosion, the force of institutional credibility. These forces will shape the next phase, and they will shape your financial life, whether you pay attention or not. The final lesson is this: the Fed is not all powerful. It can set certain rates. It can create money. It can influence liquidity. It can guide expectations. It can buy and sell assets. It can speak, but it cannot eliminate trade-offs. It cannot make too much debt painless. It cannot cut rates and guarantee no inflation. It cannot shrink the balance sheet and guarantee no rise in yields. It cannot redefine inflation and guarantee people feel richer. It cannot protect every asset price and every paycheck at the same time. The system must adjust. The question is, who pays? Savers can pay through inflation. Borrowers can pay through higher rates. Taxpayers can pay through interest costs. Workers can pay through weaker real wages. Asset owners can benefit if nominal prices rise. Bondholders can suffer if yields rise. Home buyers can suffer if mortgage rates stay elevated. The adjustment will not be evenly distributed. That is why positioning matters. Not because you can escape the system completely, because you can choose which side of certain mechanisms you are on. You can be the person whose savings are silently diluted, or you can be the person who owns productive assets and measures real returns. You can be the person trapped by high-interest debt, or you can be the person with liquidity when volatility creates opportunity. You can be the person waiting for the Fed to save them, or you can be the person building a balance sheet that can survive Fed uncertainty. That is the difference. The Fed just told us indirectly that the road ahead is not clear. Rates are not moving because the risks are too conflicted. The vote is divided because the solutions are too costly. The leadership transition is messy because power inside the institution still matters. The debt burden is forcing a new conversation because interest costs cannot be ignored forever. And the value of your paycheck is part of this story because inflation is not an abstraction. It is the loss of purchasing power in your daily life. So respond like an adult in a difficult system. Do not panic. Do not chase. Do not trust slogans. Do not hold only cash because it feels safe. Do not borrow recklessly because you expect cuts. Do not assume the next chair can make the debt problem disappear. Build resilience. Own assets that can compound. Hold liquidity, control debt, think in real terms. Watch the bond market, measure your own inflation. Understand that policy is entering a period where the old playbook may not work as cleanly as before. That is the signal. And once you see the signal, you can prepare before most people even realize the rules are changing.